So let's keep diving into the active versus passive debate here. Matt, you noted 5.5 billion of inflows so far in November. Active ETFs just breaking records for that annual total. I just wonder how much of that is equities versus fixed income. Give us a bit of a breakdown, on what you're seeing there.
So, I mean, equities have been driving a lot of the active flows. There's a lot of headlines related to it, but honestly, the active equity universe is a market of many markets. Some of these are not your alpha generating strategies. They're just active because it gives more flexibility, the buffered ETFs, if you will. They're active only because of the roll strike and some of the option flexibility from that perspective. So it's not really a lot of alpha generating active equity that are driving everything. There are some, but it's not all of it. Active fixed income has been really a consistent engine of support within the active construct, not only from flows, but also returns. A lot of the active managers are alpha generators, and roughly this year, intermediate core and intermediate core plus managers have outperformed their benchmark by roughly around 70% this year, and at a lower fee than you typically get in the mutual fund space, and with lower historical capital gains. So it's really becoming a strong sort of melting pot of beneficial results to investors. High performance, strong performance, consistent performance, lower fees, and lower, or say, improved tax efficiency. So both areas are driving the market. I think there's more opportunity in the active fixed income space from a return perspective, and there's more, I would say, flexibility in the active equity space.
And Dan, what have you seen from your clients over at Betterment? Is the emphasis still on this overall cost savings of the passive ETF wrapper, or are clients starting to express a bit more interest in some of the managed strategies?
What we've seen of late is still very much a focus on the high yield cash space. It is very, very difficult. I'm not sure that investors really ever think about even shorter intermediate term bonds as being an engine for growth and capital appreciation, as opposed to just paying out interest and income. And right now, Betterment's yielding, I think, 5 or 5.5% in their high yield cash accounts. It's very hard to get people to think about bonds when you can get that risk-free. And also, don't forget that FDIC insurance plays a very big role in people's sense of safety, especially after the events, I think, of last summer's Silicon Valley Bank, Signature Bank, et cetera. That's a really big sense of safety. They're going to be in cash savings accounts. So we tend to see more retirement assets. We now have over 13 billion in retirement assets on the platform. Those are just treated very differently than your short-term emergency fund cash interest savings accounts. It's going to be hard to get out of them.
It's interesting, too. We talked about the bond market. There's been a lot of volatility, at least on the shorter end. I wonder how, Matt, we'll go back over to you for this. How are you telling clients to kind of ride that out? I was joking with a colleague that bond market feels like the crypto market at certain points. What are you telling clients in terms of how to kind of manage that and get exposure to fixed income without some of the volatility?
Yeah, I mean, fixed income markets from a volatility perspective are quite anomalous. So you have the implied volatility on the 30-year bond, roughly about 4 percentage points in excess of that of the equity market. Typically, it is 4 percentage points below that. So rates volatility is higher than equity volatility, and that usually does not happen. So it's really unnerving. And that's why I think, going into that 30-year space, while people are saying, oh, I could just earn 5% for the next 30 years, you don't actually earn that if you're buying, unless you're buying the actual 30-year treasury, which I think many retail investors are probably not doing. They're probably buying some form of index fund that constantly rebalances. So you're not going to get that 5%. But what you are going to get is a lot of the volatility associated with it. So that's why we like striking a balance between stability and income. And that's the thing that we keep going back to with investors about creating portfolios that can generate income returns while maximizing the amount of risk that you're taking to get those. Because yields are high. Your forward-looking returns are better than they have been in a while. But with higher returns comes higher volatility. So you really need to strike that balance. We like active management in this space. We like different portions of the curve. Like I said, that 1 to 10 year space. Even mortgages, for instance, could be a beneficial allocation because they do tend to have higher yields than treasuries. And they still have that sort of full faith backing from the government. They're a defensive asset. If the Fed cuts rates and mortgage backs durations quite extended, the Fed cuts rates, you can see that come down. So I think there's a lot of opportunities there. I think it's just the whole big thing is when selecting an asset or selecting a strategy is to look at the stability of that income. And even so, like right on the cash portion of the market, that income is not going to be as stable as it once was because of reinvestment risk. And I think that's a big thing that investors are starting to grapple with is when will this reinvestment risk become real rather than implied?